Rules for carrying forward tax losses in the case of ownership changes. In the context of corporate taxation, businesses that experience a tax loss are typically allowed to carry those losses forward to offset against taxable income in future periods. However, certain specific conditions apply when there is a change of ownership in a taxable person during the tax period in which the loss is incurred. These rules are designed to prevent businesses from using tax losses inappropriately after undergoing significant changes in ownership, which could otherwise enable the shifting of profits and the manipulation of tax liabilities. The basic rule for carrying forward tax losses. For a taxable person to carry forward its tax losses, the general rule is that the owners of the taxable person must maintain continuous ownership of at least 50% from the beginning of the period in which the tax loss is incurred, until the end of the period in which the loss is eventually used to offset future taxable income. This ensures that the tax loss is directly related to the same owners who were involved in the business when the loss occurred. The continuity of ownership requirement ensures that businesses do not misuse the tax loss provisions by selling their business or ownership stake and then carrying forward losses that should not be applicable to the new owners. What happens when there is a change of ownership? In the event that there is a change in ownership of the taxable person, specific rules come into play that may still allow the business to carry forward its tax losses. A change in ownership is considered to have occurred when there is a transfer of more than 50% of the ownership interests of the taxable person. Under these circumstances, tax losses may still be carried forward, provided that the taxable person continues to operate the same or similar business after the ownership change. The requirement to continue the same or similar business ensures that tax losses are only carried forward by businesses that have not radically changed their operations or nature of business following the ownership change. This provision is in place to prevent businesses from manipulating tax losses by selling the business to new owners, who then benefit from the prior losses, even though the nature of the business has changed. Essentially, the tax authorities want to ensure that tax losses are only applied to businesses that have maintained continuity in their operations. Exclusion for listed shares on recognized stock exchanges. It is important to note that these specific rules regarding the continuity of ownership and the operation of a similar business after a change in ownership do not apply to taxable persons whose shares are listed on a recognized stock exchange. This exclusion is made because publicly traded companies often experience frequent changes in ownership through the buying and selling of shares in the stock market, and imposing such restrictions on these companies would be impractical and overly burdensome. For these types of companies, the tax loss carry-forward rules are typically less restrictive, reflecting the nature of their ownership structure and the ease with which ownership changes can occur on public markets. Example of a change in ownership with tax loss carry-forward. Let's take a practical example to illustrate how these rules work. Example: change of ownership and carrying forward tax losses. XYZ LLC is a UAE-based company that operates in the retail sector. In the tax period ending 31st December 2026, XYZ LLC incurs a tax loss of AED 5 million. The company is owned by Mr. A, who holds a 100% ownership stake in the company. In 2027, XYZ LLC's financial performance improves, and the company expects to have taxable income of AED 3 million. Mr. A plans to sell a 60% ownership stake in XYZ LLC to a group of investors as part of a restructuring. The sale of 60% ownership is a change in ownership of more than 50%, but XYZ LLC plans to continue its retail operations under the same business model with the new investors. The new investors and Mr. A agree to continue the business operations exactly as before, with no significant changes to the nature of the business. Since the business continues to operate in the same sector and in a similar manner after the ownership change, XYZ LLC may still carry forward the AED 5 million tax loss incurred in 2026, despite the 60% ownership change. In this case, the tax loss carryforward is allowed because the ownership change does not fundamentally alter the nature of the business, and the rules permit the carryforward as long as the same or similar business is continued post-ownership change.